Welcome to This Explainer. I'm your host, and today we're putting on our legal educator hats to tackle a really critical piece of the new Income Tax Act, 2025, Section 177. Whether you're a chartered accountant, a tax pro, a student, or even running a business, you absolutely need to know how corporate interest deductions are changing under the new regime. It's a total game changer for accurate tax planning, so let's get right into it. Okay, picture this scenario. Your Indian manufacturing company needs a massive injection of capital. But instead of hitting up a local bank, you borrow heavily from your foreign parent company, your associated enterprise. And naturally, you're paying them massive amounts of interest every single year. So the million-dollar question is, can you just claim all of that interest as a tax deduction to legally wipe out your taxable income in India? Well, tax authorities caught on to this, and Section 177 is literally designed to tackle this exact problem. To give you the full picture, here is our roadmap for today. We'll introduce the section, analyze the legal nuts and bolts, walk through a real-life calculation, cover the key compliance rules and exceptions, highlight some common traps to avoid, and wrap up with the big takeaways. Let's dive right into step 1. Kicking things off with the introduction and the core objective of Section 177. The main goal here is to stop a practice known as thin capitalization. Think of it this way. Tax authorities really want to make sure multinational companies aren't artificially shrinking their Indian tax bill by loading up their Indian operations with excessive debt instead of equity. Because if they do, they're just funneling massive interest payments back to their foreign affiliates. So, Section 177 steps in to limit the deduction of this excess interest for Indian companies or even foreign permanent establishments operating in India when they borrow from non-resident associated enterprises. Make sense? Moving right along, let's analyze the actual legal provision. Now, for the practicing CAs out there, you'll recognize Section 177 of the new 2025 Act as the upgraded, modernized version of Section 94B from the old 1961 Act. The core philosophy is basically the same, but there's a crucial shift in terminology you've got to catch. As the transition FAQs point out, the old Act relied heavily on the concept of a previous year, while the new 2025 Act simplifies the whole shebang. Now, we exclusively use the term tax year. So whenever you're running calculations or checking compliance for Section 177, remember, it is strictly based on the tax year. So what exactly is excess interest? This is the magic number that gets disallowed, and the Act defines it using a very strict dual condition test. Basically, excess interest is either the total interest paid that goes over 30% of the borrower's EBITDA, or it's the total interest paid specifically to those associated enterprises. And here is the kicker. The law explicitly says you have to take whichever of these two figures is less. You can't just pick the one you prefer. I want you to burn this statutory benchmark into your memory. 30%. This limitation kicks in the moment your total interest expense crosses 30% of your borrowing entity's EBITDA, earnings before interest, taxes, depreciation, and amortization, calculated for that specific tax year. Okay, enough theory. Let's look at a practical taxation example to see how this actually plays out. When you're actually doing the work, you'll follow 3 methodical steps to figure out if any interest gets disallowed. First up, calculate the Indian borrower's EBITDA for the tax year. Next, calculate that hard 30% threshold of the EBITDA. And finally, step 3, you compare that threshold against the actual interest paid or payable to the foreign associated enterprise. Let's put some real numbers to it. Say your Indian company has an EBITDA of 1,000 rupees for the tax year. Take 30% of that, and your threshold is 300 rupees. But let's say you actually paid 400 rupees in interest to your foreign parent company. Because your 400 rupee payment is over the 300 rupee statutory limit, that 100 rupee difference becomes your excess interest. And what happens to it? Under Section 177, that 100 rupees is totally disallowed as a deduction. It gets added right back to your taxable business income. Now, let's shift gears to compliance and some absolutely crucial exceptions. The law isn't totally inflexible. It provides some very specific carve-outs, mostly to protect the financial sector. Think about it. If you're a bank, an insurance company, or a notified NBFC, borrowing money and paying high interest isn't some sneaky tax avoidance scheme. It's literally your day-to-day business operations. Because of that, Indian banking companies, foreign bank branches operating in India, insurers, and those notified NBFCs are completely exempt from this Section 177 limit. Also, if you're advising a finance company located in an International Financial Services Center, an IFSC, they get a pass too. And this is a big but for compliance, you have to look at the Income Tax Rules 2026. Specifically, Rule 126 says these IFSC finance companies must be engaged in prescribed activities like lending, providing guarantees, or financial leasing to validly claim the exemption. It is definitely not automatic. You have to hit those operational conditions right on the head. All right, let's talk about the real world. Here are some common practical tax issues. A mistake I see students and even seasoned pros make all the time is fumbling that whichever is less formula we talked about earlier. If you mess that up, you could artificially inflate your client's tax bill, which nobody wants. Another huge trap, forgetting about permanent establishment triggers. This law doesn't just hit Indian subsidiaries, it applies to foreign companies with a PE in India too. And lastly, as we move from the 1961 Act to the 2025 Act, you've got to make sure your software and documentation are updated for the new tax year concept. The old previous year terminology is officially history. Let's wrap things up with a quick summary and our final takeaways. To sum it all up, Section 177 is basically India's shield against profit shifting through thin capitalization. If you're doing corporate tax planning, mastering that 30% EBITDA calculation is non-negotiable. Keep in mind it's the direct replacement for the old Section 94B. And always double-check if your client qualifies for an exemption, like being a bank or a Rule 126 compliance IFSC finance company. Getting these details right is exactly how you keep things fully compliant while optimizing those tax positions. As these multinational corporate structures get more and more complex, strict anti-abuse rules like Section 177 are only going to become more important. So I'll leave you with this. How would your current debt structures hold up against this 30% test under a strict audit? Thank you so much for joining me today. Please like, subscribe, and share. Just a quick reminder, this explainer is for educational purposes only and does not constitute professional advice. Tax logs are always subject to amendments, so please consult your professional advisor before taking any action. This is an AI-generated educational explainer.